Tesla's down 2% today, and I posted on X that I'm still holding my December 26, 2027 calls. $450 is my current strike. Tesla was down today, but the BX Trender, which is the indicator that we look for when it comes to institutional buying pressure, actually flipped from red to green, which is a sign that buyers are stepping in. And if buyers are stepping in, then that means they could bid price higher, which is obviously going to push the stock up. If buyers are not coming into the market, then the stock will not go up. And within that post, I also went over the worst case scenario of what I think is going to happen for Tesla in the next couple of weeks, and specifically what I plan to do. I said that the weekly candle closes tomorrow, which is one of the most important timeframes because it is the strongest time frame that we have. This is why I tell you guys that even if you're long-term investors and you don't care about trading, you should still know how to read the weekly chart, and you should still know how to read the monthly chart. Because even if I want to invest in Tesla long term, I don't want to be doing it when there's institutional selling pressure coming in. So I wouldn't have cared to own it nearly all of 2023, and I wouldn't have cared to start looking at this long term, which is when we were looking at this back in June. In that post, I said that if the weekly BX closes red tomorrow, this could mean a potential short-term top for Tesla until earnings. You can see that right now on the weekly chart that the BX line, not the histogram, the line is now showing red. We don't care about this candle or any candle until it closes. So what we base all of our trading off of is what happened in the prior candle. The prior candle is still green, which is why I still remain bullish on Tesla. I said that institutions would not continue to step in if the BX flipped, showing that buying pressure would be leaving, and they would wait to get back in at a more discounted price. This would most likely trap retail, only pushing price back to $400 or $375. As I said in the beginning, I'm very much still a bull and holding a sizable position, but we need to stay objective here. If price sells off, this is only going to give us a better opportunity to load up on the next expansion. The drawing of the chart that I attached was this daily time frame. You can see that our bot is looking to enter when the BX flips from green to red when we are in a strong uptrend. We had a small position here from November 21st to November 22nd, which ended up hitting a small trade. Exited the position for about a week because buying pressure was not entering the market. Price pushed up, and then we triggered an entry here on December 3rd, 2024. From here, we would have held this position and then taken it off the table back here on December 16th. And now remember, just because this BX Trender flips from green to red doesn't mean that we short. I wouldn't be shorting Tesla here at all. I want you to think of this as a buy mode versus a hold mode. When price is expanding like this, we want to be buying into that market. I want you to think of this more as like capital conservation mode versus capital appreciation mode. When we are in an uptrend and the BX is green and we're expanding much like we were doing back in the beginning of December, we want to be buying into that market, and as long as we continue to hold green, we are fine to be playing the upside. When the BX flips red, whether it's the daily or the weekly, that doesn't mean to short. It just means that we might want to remove some risk from the table short term because price will probably consolidate or even sell off, much like it's been doing for the past week or so. You know, it sold off worst case 14%, but really we've just been consolidating in price. Now, as far as right now, best case scenario for myself would be that price comes out of this pullback and breaks out into a higher high. This would cause Tesla to move back up to 500, 510, or maybe even 520. If that doesn't happen, then we will most likely have this be the high, reject and make lower highs, selling back off into lower lows, back off into lower highs, and then into lower lows, worst case, selling off into the smart money zone. You have to remember, if we are not in an expansion, then we need to be waiting for price to pull back down into a discounted range. And in this case, the institutional buy zone is $390 down to $357. If you want to learn how to spot these institutional buy zones to perfection within 30 minutes, we have a free course going over it down in our full course library. In this case, I would continue to hold my 2027 calls and just average down or sell cash secured puts down into $350 to $375, which once again, I think is the absolute worst case scenario. S&P 500 recovered nicely after last week's sell-off. We saw that 3% drop that happened on the 18th when the Fed came out, gave their decision. Jerome Powell was very, very hawkish, talking about limited cuts going into 2025, which is not what the market wanted to hear. After that sell-off, we marked this area of $582 to $580 as an area of interest and a liquidity zone. The reason for this is because we bounced here before. There's also a $74 million support level where orders came in prior. And we know that in most cases, if we bounce there before, price is going to bounce again. Now, with that being said, while a lot of people are expecting this Santa rally to happen, and while a lot of people are expecting this breakout to continue, and while I personally hope that happens, we always have to remain objective here. And if we zoom out, we are in a strong uptrend, but the BX trender on the weekly is currently red. And you can see that that flipped last week. And in most cases, when we're in a strong uptrend like this and the BX flips red, it doesn't mean that we should be shorting, but it does mean that price is normally going to fall back down into a support level before making a next level expansion. You can see this happen back here in April before this next expansion, happened again back here in July before the next expansion, happened back here in October before the next expansion, and is now happening at this time. Now, this does not mean that I'm going to go short on the market. I never short the market unless we are in a consistent downtrend, meaning that price is making lower lows and lower highs. And if you look at what we're doing right now, we are making higher highs and higher lows. So when we see the weekly BX trender showing institutions leaving, people who can actually move the market leaving in an uptrend, once again, it doesn't mean we short. It just means that we take a break or we remove basically how long we are on some of our positions. If we look at the daily chart for the S&P 500, you know we bounce off the support that we said before. But what my fear is here, because the weekly is red, is that this is going to be a trap. And in most cases, we know that price is looking to make higher highs in an uptrend and higher lows. But what I think could happen at this point is if we take our Fibonacci retracement from this high of 608 down to this low of $581, that we could have a potential head and shoulders forming. Now, a head and shoulders happens when price breaks out, pulls back down to a key support level. In this case was 583 to 580. Price breaks out into a higher high. Now, this looks like healthy, normal structure. But instead of coming back down to make a higher low and then breaking out, it comes back down to make an equal low. And this equal low is very important because it shows that buyers didn't quite step in early, which means that there's not as much strength from the buyers that there was on that prior push, meaning this push back here. And so when you see a premature bounce like this, that could be indicative of a higher high because it could mean that bigger buyers are sitting there to buy the dip. In this case, the equal low shows in most cases weakness. And so what will normally happen is price will break out, trapping retail or everyday traders to think that we're going to push into a higher high, when in reality, we push into a lower high, reject at our smart money zone, which is this 0.826 to 0.786 level. We talk about that in our smart money zone course, which is completely free in the course library down in the description. And from there, price will pull back down to this support level of 580, making our head and shoulders pattern. You can tell because this first push is going to be the shoulder. The next one is the head. The lower one is the shoulder. And then normally we will break and fill the gap, selling off worst case to probably $570. Now, as I said, I don't plan to short the market. I'm still long a lot of trades, not a lot of them that are big players in the S&P 500, but that's how I'm viewing SPY heading into the next couple of weeks and next couple of months. And if you look at the monthly chart, zooming out even further, you'll see that while we are in this expansion, the BX trender is red. Last time that happened, we consolidated for multiple months sideways. Before that was August 2023, where we sold off 4 months in a row. And then before that was back in 2021, where we sold off for nearly 16 months. And so I'm not here to doom and gloom or to worry or say that this is the top, but remember, we have to remain objective here. And so while I'm still bullish on the market until this trend shifts, I will say that I'm a bit less aggressive as far as my short-term outlook. Let's move into semiconductors and let's start first with NVIDIA. You guys know that I have not been bullish on NVIDIA for about the past month to a month and a half. And when I say that, it doesn't mean that I've been bearish. It doesn't mean that I'm going to short a stock, much like we talk a lot here on this channel, that I'm never going to short a stock when it's in an uptrend. But that being said, just because something is in an uptrend does not mean that we need to be bullish. What we look for is areas or breakouts called expansions. These happen when a stock is in an uptrend, like you can see here. But instead of just being in an uptrend, we need to know that buyers or specifically institutions are entering this stock so that we know that they have the actual capital to bid the stock higher. You have to remember that the price of an asset, whether it's trading cards or a stock, there has to be people there willing to overpay for it in order to push the price higher. If there's no demand, if there's nobody there to buy it, then this asset is not going to go up. And in this case, it's the same thing with NVIDIA. When the BX flips from red to green, this line here at the bottom of your screen, you can see that we are normally in what's called an expansion. And these expansions or breakouts will normally last until that flips back from green to red. Once again, this green to red flip does not mean that we are looking to short. I mean, I know people will look to short this type of setup, but for me, the juice isn't worth the squeeze. For instance, this breakout from low to high was 92%. I could have traded that for multiple months. I could have done any trading style. I could have day traded, swing traded, used whatever indicator, right? If I'm trading in that type of market, that type of macro market, I can make money doing anything. And that's normally what happens. Now, for most traders and most, public traders, this type of market, when we flip from green to red, is where things get wishy-washy because they normally try to short. And if you're good at it, you might make some money. But normally it's a lot of people trying to just continue to buy the dip, buy the dip, buy the dip, and then hopefully they can ride it out before the next move happens. This is why I instead focus on only trading in this type of environment and then sitting out, not shorting, but sitting out during this type of environment, waiting for the environment to switch like we see happen here in May of 2024 back to bullish. And then we can trade NVIDIA and trade this asset until June. This was a 50% move to the upside. Now, I got hate on the internet the past 3 times that I called the top on NVIDIA, calling the top back here March 18th, 2024. You can go to my X account and literally just go to the date and you will see that within that time frame, we were not short on NVIDIA, but calling the short-term top. The same deal happens back here in June of 2024. You can see that price initially actually bounces, trapping retail once again, before we end up selling off this time actually about 27%. From this point, price bounces, and then once again, we could become bullish on this because we're getting institutional buying. While price actually initially sells off pretty aggressively, we still could have continued to hold this position all the way out till the end of October to November, giving us about a 20% move. So realize that if we were just trading NVIDIA or even investing in NVIDIA during these 3 key times, we could have saved ourselves a crap ton of headaches. And yes, is there money to be made within these areas? Yes, but is it worth the risk to me? No, in most cases, I'm just going to go find something else that's trading in this type of environment. And so what I think is most likely going to happen with NVIDIA at this point is what we've been saying for multiple months now. This flip from green to red indicates that price is going to sell off, worst case, back down to $120. In the instance of this, I think that we will see, like we said, one more sell off, bouncing at trendline support before eventually pushing our way back up to maybe 150 and 170 in March or April. That is my worst case analysis for NVIDIA. Best case scenario, we basically have what just happened to Meta. We get this breakout, price pulls back only to break out once again, much like what's currently happening at this point. So I think best case, NVIDIA breaks out here. Worst case, we retest back down to $120. And now, before we move on from this, I don't want people, because I see a lot of people commenting like, oh, great, you think it'll either go up or go down. No, that's not how this works, right? That's not how trading is. All of trading is if-and statements, right? So we zoom out to the weekly. If the weekly chart is in an uptrend, Then we look to the weekly BX. If the weekly BX is green, then we move to the daily chart to look for an entry. In the case of NVIDIA, the weekly chart is not green, so we wait. That's how you should be looking at all of this. So with NVIDIA, if price breaks up over 145 and the weekly turns green, then we go long. If it rejects here and the weekly stays red, then we wait for one more pullback down to $120. And if we drop down to $120 and the weekly turns green, then we move to the daily and take the position. This is how trading works. There's no emotion, there's no wondering. It's only if and or then statements, much like coding. Let's talk about AMD because this has been one of the worst stocks for me in 2024, but I believe it's going to be one of the best stocks for me heading into 2025 and for almost all of 2025. I think that this thing has the potential to have the year that Tesla has had specifically in the past 6 months. Now, looking at this at the weekly, we're going to just do a quick update because we did a very detailed breakdown last week. Price has sold off drastically from this high back in March of 2024. And you can see that from that low to that high, price has pulled back about 80% from the low to the high. It doesn't mean 80% of the actual stock, but from $90 to $200, it's about an 80% pullback. This is marked off by the purple that you see on my chart. If you want to learn to draw these smart money zones in less than 30 minutes, there's a free course in the course library link down in the description. These areas are very important, which you can see we had one back here because they show us the lowest level which institutions are going to pull the stock back to before they buy it up, because institutions are not going to be buying the stock up at all-time highs. They are going to be selling that stock to retail everyday investors so that they can exit their position because they were entering back here. You have to remember that these people don't operate the way that you and I do. They're not going to hit the market order button. They don't just feel what they're going to do. No, they have strict limit orders and specific plans in specific areas of where they are going to deploy capital. And if it's not within that specific area, then the stock in most cases is not going to run. And last week and the week before, we saw price pull back into these institutional levels and do what's called a stop hunt. Now, a stop hunt happens when we break a key support level, such as $133. They will purposefully drive the stock through that support level, tag out everyone who has stop losses, only to just drive the price right back up to where it was trading because they were able to buy it at a super cheap discount, specifically in the options market. And so far, that's exactly what we're seeing at this point. You'll also notice zooming out that there is $1.5 billion support shelf that's also sitting here and a very small amount of volume from $122 up to $150. And what this means is that because there's so little volume within these levels, that price can bounce and recover all the way back up to $160 just as fast as it's sold off, meaning that the sell-off that lasted for about 2 months could fully get bought back up within the next 2 months, giving us at least a 30% move back up to $170 before potential rejection. And in this case, that's why I'm still holding my February calls. Now, if price rejects this week and the whole market continues to sell off and AMD sells off as well, then I will close out my February calls and roll them out to a much longer time frame. I still think that AMD is going to do very, very well over the next 3, 6, and even 12 months. It's just getting through the short-term BS that we have to deal with. Let's do an update on some Chinese names such as NIO and Alibaba, because last week and the week before we were talking about how we were long on NIO specifically because of a couple of reasons. Number one is looking at the weekly chart, you can see that price has broken structure. This happens when we go from making lower highs and lower lows to breaking over a most recent high, which you can see happened back here on September 23rd, therefore switching the trend. Now price is actually making higher highs and now higher lows. This is a very, very good sign. And if we were to take our Fibonacci retracement from that low to that high, you'll notice that the main area we look at is this area, the 0.786 and the 0.826. This area is called our smart money zone. We have an entire course on it in the description. Like we always say, it's completely free. Go ahead and check it out. This area is extremely important because it is going to be the lowest area that institutions will allow the stock to pull back to within an uptrend before they buy and push the stock back up higher. And so the fact that we've been holding this $4.70 support level is very, very good. You're also going to see these horizontal bars on the right side of my screen. This represents volume, but not the normal volume that you'll see on a chart. Normally, people are looking at vertical volume bars, which is going to show how many shares were traded in a day. This is going to show me where those shares were traded within the past couple of years. And you will see the area that has the most trading volume is right here at $4.70. And so these areas tend to act as major support levels, which we're seeing happening here, showing the BX flipping from red to green, meaning that institutions are entering NEO. And this is normally a sign that this compression that we're currently seeing is going to lead to a significant expansion, much like it did back here in August and September. And this is why I'm very bullish heading into Q1 of 2025 for NEO, because institutions are getting behind this. I think there's a good chance that price can move its way back up to $6 and maybe even $7.50 by the end of March. And even better, if we zoom in on the daily time frame, you can see that we have held this support level, we are pushing through this resistance, and that this is even further confirming the potential move back up to $5.20. Alibaba is also finding a strong support level right underneath this point of control. We're close to about $1 billion in volume sitting at this level. You can see we're inside of our institutional support, and the BX trender flipped from red to green back in the beginning of December. This is normally a sign that price is going to bounce. The past 3 times that we've tried to time this, we did make a profit for 1 or 2 of them, but overall it's been a bit of a wash. What we're looking for is to get in when the BX flips from red to green, which you can see happened here. From there, all of our bots will trigger within the Discord community, and we're waiting for the BX to flip back from green to red, resulting in an expansion most likely in the next couple of weeks to fill this gap up to $92, $95, and maybe even $100. If we zoom back out, I think that there's a very good chance over the next 3 to 6 months that price could even push its way back up to equal highs of $116, resulting in a potential 42% return. And given the fact that we have a very tight stop loss set and close our trade when the BX flips back to red, it means that our max downside will be around 10%, which is not bad at all, leaving us with about a 4-to-1 risk versus reward. I ran a poll on X about what stocks you want me to do an update on a weekly chart, and Uber was one of the top answers, and it's actually in a very good situation. I want to talk about why I might actually take a position on this and go over the technical setup. Now, looking at Uber, the first thing that we have to understand is that the structure for the market currently is bullish. The easiest way to figure this out is to look at highs and lows. You can see that back here in 2021 down to 2022, price was consistently making lower highs. So many people get lost about drawing trend lines, but the easiest way is to just look at the highs. So if we're trading in this type of market for Uber, then we are in a bearish structure, and the trend is also bearish. You can see by making lower lows as well. Now, once price actually breaks that trend and we start making higher highs and higher lows, this is a sign that we are now in a bullish structure. Now, so many people get really too into trend lines. Honestly, I don't care about the line specifically. I just care that we're making higher highs. I don't need it to bounce at this line. But what I want to do is more so look at those lows and highs and isolate those areas to find the range. If we look at all of these prior lows, we can mark them all off. But what I really care about is the most recent lows that we have, mainly being here at 41.36, but the most important one being here at $54.58. If we look at the most recent low from $54.58 up to the most recent high at $86, this is going to be the most recent trading range. Now, understanding trading ranges are very important because institutions, the people who actually move the market, the people who have the money to bid it up, they're not going to buy when a range is overpriced. These people don't put market orders in. They're not going to buy hundreds of millions of dollars when the stock's at all-time high. That's not what they're doing. They are going to build positions within pullbacks in uptrends. And so what we're looking for in this case is price to pull back down into this support level of $62 before bouncing its way back up. And the way that we would find this area is by taking a Fibonacci retracement from low to high. And if we were to do that, you'll see that our institutional support level is right here. If you want to learn how to draw and find those smart money zones within 30 minutes, we have a free course going over it in our course library. It's called our Smart Money Zone Mastery course. You'll find the link in the description. In most cases, there's a very high chance that price is going to bounce at that level because we are at such a discounted zone that it's almost silly for institutions to not step in. It is the area where they have the most upside for the smallest amount of downside. And that's why I usually trade these areas alongside of them. If this BX trender flips from red to green, this will also indicate that buyers are stepping in. And that would be a time for me to turn on my trading bots and look to go long. So this is something I will monitor into tomorrow's close. Now, if this does close like this, we would set a target up around $75 and $85 with a stop loss at lower lows. If this area does break, then the next level of support that we will sell off to, and this is why I would close very quickly, is going to be back down to $50, worst case $48. The reason for this is because if we now don't go from this low of 55, but go from our further low of down here about $40, you're going to see that our macro smart money zone is actually sitting around this level, which is also backed up by this big area of support on our volume profile. So that's why I think that if we do not bounce here, that's my time to just walk away. I'd rather get in, take the loss, move on, than holding this thing back down to $50.